Okay, you guys, we're going to take a look at exercise 15-8. We're actually going to do 8, 9, and 10. They're all three connected. The first one, we're dealing with the entries that the lessee would make when they're dealing with a capital lease. And then they actually don't ask us to make the entries. They're just wanting us to determine how the journal entries associated with this lease would affect the balance sheet and the income statement. But I think probably the easiest way to determine that is make the entries, look at them, and then decide how they affected the financial statements. But first, let's read through it. Let's say on June 30th, 2016, Georgia Atlantic Incorporated leased a warehouse facility from IC Leasing Corporation. The lease agreement calls for Georgia Atlantic to make semi-annual lease payments of $562,907 over a 3-year lease term. And they are payable each June 30th and December 31st, with the first payment at June 30th, 2016. Now that's important. First payment is June 30th, 2016. That's the day the lease is drawn. That means these payments are made at the beginning of each term rather than at the end. That makes this an annuity due rather than an ordinary annuity. With an ordinary annuity, the payment is made at the end of each interest payment period. With an annuity due, the payments are made at the beginning of each payment period. So we're dealing here with an annuity due. We'll remember that when we go to the present value tables. Georgia Atlantic's incremental borrowing rate is 10%, the same rate that IC uses to calculate lease payment amounts. Depreciation is recorded on a straight line basis at the end of the fiscal year, and the fair value of the warehouse is $3 million. Okay. And I don't see anything about a residual value, so I guess we're to assume it's 0 when we get to that portion. But number one, they said determine the present value of the lease payments at June 30th, 2016 to the nearest $100. And this would be the number that Georgia Atlantic uses to record the leased asset and lease liability. Okay. So what they're saying is, what the payment amount is $562,907. What they're asking is that much every 6 months, starting today. I'll give you the first payment today, and then I'll give you that much every 6 months for 3 years. How much is that worth in today's dollars, assuming an interest rate of 10% annually? Okay, if the interest rate is 10% annually, then it's 5% every 6 months. So what we're dealing with here is an interest rate equal to 5%. And how many interest payment periods? Well, interest will be paid twice a year for 3 years, so N is equal to 6. Okay, now remember, we're going to the table present value of an annuity due. So it's present value of an annuity due. That's the table we want to use. It's an annuity due because the first payment is scheduled to be made on the day the lease is drawn, so no time has passed off when the first payment is made. That's an annuity due. An ordinary annuity, the first payment would be made at the end of the first interest payment period rather than at the beginning. Okay, so we'll go to that table, present value of an annuity due. I believe that's on the very last page in your textbook, P-6. We'll come down to 6 periods. That's interest paid twice a year for 3 years. That gets us 6 interest payment periods. and it's 10% for a year. So for half a year, it's 5%. So we come down to 6 periods in the left-hand column, come across to the 5% column, and I get 5.32948. What we'll do is say it's equal to 562,000. What was that payment amount? 907 times our factor from the table, 5.32948. And that gives us the present value of those lease payments is approximately $3 million. They said do it to the nearest, round it to the nearest 100 anyway, so we're definitely within 100 there. It really should just be 3 million, y'all. We'll just have a little bit of difference due to rounding. 3 million is the number we will use. Also, so they say number one, ask us to determine the present value of the lease payments at June 30th, 2016 that Georgia Atlantic uses to record the leased asset and lease liability. Well, there you go. It's going to be $3 million. So I'm going to make the entries. I think that's going to help us to determine these balances that they're asking for that are going to show up on the income statement and balance sheet. June 30th, we'll debit leased asset for $3 million, or $3 million and two, whichever you prefer. I'm just going to go with the $3 million. A little rounding difference there. And then the account will credit as lease payable. And lease payable would be credited for $3 million as well. Okay. Okay, let's continue with the journal entries that the lessee would make here. Also on June 30th, they made a lease payment, so they debit lease payable for the amount of the payment. That was $562,907, and that's going to be, of course, a credit to cash. No interest is involved in this journal entry because no time has passed off since the lease was drawn up. Their next entry and only other entry associated with this lease, or no, there's two more. Only other entry associated with the lease payable that will occur this year would be on December 31st. When the other payment is made, well, we know we're going to credit cash for the $562,907. The debit to interest expense would be calculated by saying $3 million, the original amount in the lease payable account, minus the part of the lease that was taken care of there on June 30th, or the debit to lease payable. And then we're going to multiply by the interest rate for a half a year, because that's how much we're dealing with a half year's interest here. It's 10% for a year, so it'd be times 5%, or 0.05 for a half year. Sorry, excuse me. It's incorrect. No, it's not. The number is just higher than I was expecting it to be. Going back through the formula, you take your credit to lease payable, the $3 million, minus the debit to lease payable, $562,907, times the interest rate for a half. Well, that wasn't incorrect. It's a higher number than I was expecting it to be. You do take your credit to lease payable, the $3 million. Subtract the debit to lease payable, the $562,907, then multiply by the interest rate for a half year, and you get your interest expense for that 6-month period, $121,855. Okay, we'll debit lease payable as well to reduce its balance. Let's come back to that one though. We know we're going to credit cash for $562,907. So our debit to lease payable would be equal to $562,907, the credit to cash, minus the interest expense portion of the payment. The other portion is used to reduce the balance in lease payable. Okay, now that takes care of the entries associated with the lease for the year. Also on the 31st though, we would record depreciation expense. Because remember, this even though it's worded as a lease, this does meet the criteria of being classified as a capital lease. We record it just like a purchase. We put the asset on the books up here, right? And we'll also depreciate that asset as time passes off. The way we can know that this one is a capital lease is the present value of the minimum lease payments is $3 million. That's also the fair value of the leased property, and this number would only have to be 90% or more of the fair value of the leased property for it to be classified as a capital lease. So our company here, Georgia Atlantic, will depreciate the asset. It would be calculated as $3 million divided by 3 years, the useful life of the asset to Georgia Atlantic. But you guys, the asset's only been in service for 6 months. With this calculation, I took a full year's depreciation when the asset had only been in service 6 months. So you can take the $3 million divided by 3 years. Then you have to multiply times 0.5 for a half year. The asset was only placed in service on June 30th. So depreciation expense for the year should be $500,000, and that's our credit to accumulated depreciation. Okay. Now, on requirement 2, they ask us, what amounts related to the lease would Georgia Atlantic report in its balance sheet at December 31, 2016, ignoring taxes? Okay, they would have lease payable as a liability. I guess we could start with the asset. For the asset, they'd have leased asset. Its balance would be $3 million to begin with. Okay, and then we would want to deduct the accumulated depreciation. So that's a negative $500,000. So we could say leased asset net, or meaning at its book value on December 31, 2016 will be equal to the $3 million, and you can say plus the negative number. Gets us down to $2,500,000. That's what the asset would be on the books at the end of the year, you guys. Now we also had a liability. lease payable. Okay, it started out at $3 million. Right then, we had the June 30th payment. Okay, now on the June 30th payment, we could deduct the entire amount of the payment from the balance of the lease because no time had passed off, there was no interest expense. So it's a negative $562,907. And then you got the December 31st payment. Okay, now here we can only deduct the debit to lease payable because a portion of that payment was interest. 6 months interest on that payment. Okay, so we'll say it's equal to a negative $441.52. And we'll tally these. There you go. There's your liability balance, lease payable at December 31, 2016, the $1,996,041. And then on requirement 3, they want to know, I believe, the income statement effect. What amounts related to the lease would Georgia Atlantic report in its income statement for the year ended December 31, 2016? Well, you'd only have expenses, you guys. You'd have some interest expense here, and you'd have some depreciation expense here, and then you'd also have the well, I started to say you'd have some more interest, but you wouldn't. The interest is caught up. Payment was made on December 31st, so you'd have interest expense for 2016. Now this is just associated with this lease. The company could have had other interest expense, of course, would be equal to the debit to interest expense over here. So once you make the journal entries, you've got all this information laid out for you. And then the other expense would be depreciation expense, which comes from here. And there's your answer for that's depreciation expense, should say, for 2016. Now that's associated with this asset only. This is interest expense associated only with this lease. Okay. To me, you guys, they didn't ask you to do the journal entries, but to me, this part was requirements 2 and 3 are much easier to do when I have the journal entries to look at. If you can do this without it, that's fine too. Okay, I think after working that one with me, you should be ready for your next homework problem in Connect Plus. It's exercise 5.8. Thanks, and good luck.